Welcome back to the deep dive. We're here to cut through the noise, get straight to the strategy.
And right now, there is a lot of noise, isn't there?
Oh, yeah. I mean, everywhere you look, it's AI tokens, Solana ETFs, crazy yield farms. It's all high-octane stuff.
It absolutely is. And look, that's where some serious growth potential lies, no doubt about it. But, that constant focus on the super volatile, it can make investors kind of forget the basics, the building blocks.
Right. So the tension for you listening is probably this. How do you actually chase that crypto upside, that asymmetry, without ditching the reliable stuff, the compounding you get from traditional low-cost assets?
That's the million-dollar question, isn't it?
That's exactly the mission for this deep dive. We are not saying pick one or the other, digital assets or traditional. What we're doing is giving you a shortcut to what you might call a hybrid finance strategy.
Blending things.
Yeah, blending that high-risk crypto feel with the stability and the income you can get from something like Vanguard's low-cost ETFs.
It's helpful to think of it like this. Your crypto. That's your rocket engine. It's got the huge thrust potential.
Okay.
But the traditional ETFs, that's the rocket itself, the structure.
Yeah.
It gives you stability, ballast, holds a fuel reserve. They really are the backbone for building wealth long-term, designed for compounding, not just chasing daily price pops.
Okay, so let's unpack this strategy then. We looked into it and picked out 3 specific Vanguard ETFs. Each one does a different job: growth, innovation, and yield.
3 distinct roles.
Exactly. We'll look at what each one does strategically and then kind of tie them together into a balanced approach, something resilient for, say, heading into 2026.
Makes sense. Where do we start? Stability first.
Let's start right there with VOO, the Vanguard S&P 500 ETF.
Ah, the classic.
The classic, yeah. People call it set it and forget it. Tracks the 500 biggest U.S. companies: Apple, Walmart, Coke, Bank of America. You know the names. It feels conservative, but is it really slow money anymore, especially when it's passively soaking up all this AI boom growth?
That's a great point. That's the hidden insight, maybe. VOO has this critical built-in momentum. Because it's a market cap weighted, right? So its exposure to the big tech names, Apple, Microsoft, NVIDIA, means you automatically get a piece of that AI growth. You don't have to pick the winner.
Passive participation.
Exactly. That's crucial.
And the numbers that really matter for your balance sheet, they're pretty stunning. Yeah, the price is up there, over $600, up over 21% in the past year. But for a smart investor like you listening, 2 things really jump out. First, that expense ratio. 0.03%.
Tiny.
It's basically zero.
And that 0.03%, that's the game changer. It means Vanguard's taking practically nothing from your returns over time. Think about that compared to like an active mutual fund or even some staking fees. That near zero cost just maximizes your passive returns. It lets the compounding engine work efficiently.
And the other thing is liquidity, right? Super high liquidity, very low tracking error.
Exactly.
Yeah.
So if you're balancing out a volatile crypto portfolio, VOO isn't just an investment. It's also like highly liquid collateral. It's your stability anchor. Gives you instant passive exposure to the whole U.S. economy.
So if crypto dumps.
Yeah, if crypto takes a dive, which it inevitably does sometimes, this stable base means you're less likely to panic sell. You don't have to chase the daily swings so much. It's the perfect foundation for rebalancing later.
Okay, got it. Foundation set, stability, large cap growth with VOO. But that's only half the story, maybe. VOO is super concentrated in those big tech names.
It is, yeah. Cop heavy.
So if stability is the goal, why add more complexity? Why bet on smaller, riskier companies? Why do we need another growth engine like VTWO? Isn't that just adding risk we don't need?
That's a fair challenge. And the problem with only holding VOO is exactly that. Concentration risk. If those top 10 giants slow down, your whole ETF portion takes a hit.
Oh, okay.
So VTWO, the Vanguard Russell 2000 ETF, that's your offset. Your diversification within U.S. stocks. It tracks 2,000 small-cap U.S. stocks.
Little guys.
Yeah, America's sort of emerging innovators.
So it's less about today's giants, more about betting on the next generation of growth, the overall health of the economy down the line.
Precisely. It's the innovation play. And it offers domestic growth that's hopefully not perfectly correlated with the mega caps. The research suggests this is a forward-looking play, too.
How so?
Well, the price is around $99. Performance YTD is solid, like 13%.
Yeah.
But the real strategic value might be in performance rotation. Analysts are expecting small caps could actually outperform in 2026, especially if interest rates stabilize.
Okay.
When money eventually flows out of those huge winners, where does it go? Often into these smaller, maybe more leveraged growth sectors.
So VTWO isn't just growth for growth's sake, it's tactical. diversifying away from that big tech concentration in VOO and positioning for maybe a different kind of economic recovery led by smaller firms.
You got it.
Yeah.
And again, look at the cost. The expense ratio is still tiny, 0.07%.
Wow. Still practically nothing.
Exactly. So it lets you participate in, like, the whole breadth of American innovation, not just the top 5 or 10 names.
Yeah.
That's key for real diversification.
Okay, so VOO for stability and passive momentum. VTWO for future innovation, diversification, got the growth covered, now we need defense.
Right.
Something that kicks off cash flow, maybe acts as a hedge if tech hits turbulence.
Which it does.
Which it does. So that brings us to the third role, defense and income. ETF number 3, VDE.
VDE, the Vanguard Energy ETF. This is your counterweight, your portfolio insurance, in a way. Tracks about 111 energy companies. Think ExxonMobil, Chevron, ConocoPhillips, the big energy players.
Right. And for a portfolio that might be heavy on tech or crypto, this provides something totally different.
Completely different correlation profile.
And the numbers immediately show you why it's the income piece. Performance year-to-date is modest, less than 3% up, but that dividend yield, 3.09%.
Significantly higher.
Way higher than VOO or VTWO, so it's really a cash flow generator.
It is. And what's really interesting is its strategic role. VDE is a classic inflation hedge, often performs well, or at least holds up better, when commodity prices spike and growth stocks suffer. It gives you real-world asset exposure tied to energy, geopolitics.
So if your tech and AI bets get hammered by unexpected inflation or some global conflict,
VDE is designed to help stabilize things, provide some ballast.
And it's genuinely non-correlated, right? That's the key insight. Plus, the research we saw noted that with oil maybe being a bit suppressed in 2025, the sector might actually be undervalued going into 2026.
That's the potential kicker. Several big banks are forecasting potential capital gains if oil demand picks back up. So VDE might offer not just that defensive yield, but maybe some capital appreciation too.
So it's not just insurance, it's insurance that pays you while you wait.
Exactly. Pays you a decent dividend.
Okay, that makes sense. That feels like the essential trio then. So now let's synthesize. The smart investors play. How do we put these together?
Right. We have the roles. VOO, large cap stability, momentum. VTWO, small cap innovation, rotation potential. VDE yield, cash flow, inflation hedge.
How do you allocate? What's the mix?
So looking at the data, trying to build for resilience, a recommended balanced example for 2026 could look like this.
Okay.
50% in VOO, that's your foundation.
Okay.
Then 30% in VTWO for that innovation and growth rotation aspect.
30% VDB.
And the remaining 20% in VDE for the yield and the defensive hedge.
50% VOO, 30% VDBUO, 20% VDE. Okay, I have to push back a little here. 50% in VOO. That sounds kind of conservative, especially if you're someone already playing in crypto looking for high growth. Are we maybe being too cautious with that split?
It's a really important question.
Yeah.
And that 50% VOO allocation,
yeah,
it's absolutely critical, I'd argue. It's designed specifically to lower the risk of having to liquidate your crypto when things get ugly.
Okay, liquidation risk.
Exactly. That big 50% slug ensures you have deep liquidity and that stability premium. It acts as a buffer against big drops in your asymmetric bets. It basically allows you to hold your crypto long-term through the cycles without being forced to sell at the bottom.
So the goal for the ETF side isn't just maximum growth. It's maximum resilience for the whole hybrid portfolio.
Precisely. Maximum resilience.
And when you look at the cost of that resilience, it's almost nothing. That 50-30-20 mix, the total weighted expense ratio comes out under 0.05% on average.
Yeah, incredibly efficient. That level of efficiency is like a secret weapon for compounding over decades.
Yeah.
And if you connect this back to the big picture strategy, this balanced allocation, it forms one side of that classic barbell strategy.
The barbell. One side is stable, generates dividends, the ETFs, compounding growth, cash flow.
And the other side, that's your volatile, opportunistic crypto holdings, your moonshots.
And we're actually seeing this play out, right? This idea of crypto to ETF diversification.
We are. The data shows something like a 40% jump in investors holding both crypto and ETFs at the same time. People are getting it.
So the strategy gives you consistent dividend income, durable growth from the ETF side, while the crypto side can stay aggressive, opportunistic.
You get stability that pays you and volatility that, could potentially transform your wealth. Best of both worlds, maybe.
Okay, so that brings us to the final takeaway for you. You should now have the knowledge, the framework for building a genuinely diversified hybrid portfolio, combining growth, innovation, and yield from traditional markets, creating that stable, compounding base underneath whatever high volatility crypto you might hold. This is really about building durable wealth for the long haul.
Thinking strategically.
So here's a final thought to chew on as you go, a provocative question maybe. Are we really entering a kind of balance era, where the truly smart investor owns both Bitcoin and Vanguard?
Interesting question.
And if so, what percentage of your total portfolio, crypto included, should really go to those volatile, asymmetric assets versus the stable, dividend-paying ones?
That's something pretty fundamental to think about as you plan your own strategy for 2026 and beyond.
Definitely something to mull over. And hey, before we sign off, if you found this deep dive useful, if it gave you something valuable,
We'd really appreciate the support.
yeah, engaging with us, subscribing, dropping a comment, liking the video, it actually does help us a lot. Helps boost visibility in the algorithm.
Let's just keep making this kind of smart, balanced content for you.
We genuinely appreciate it. Thanks for tuning in.
We'll catch you on the next deep dive.